If you earn over $150,000 a year and you're counting on your 401k catch-up contributions to lower your tax bill, January 2026 changes everything. This is Money Moves Daily, where we cut through the noise to give you the financial signals that actually matter. I'm here to break down one of the biggest retirement rule changes in decades. Here's the headline. Starting January 1st, 2026, if your W-2 wages exceeded $150,000, every single dollar of your catch-up contributions must go into a Roth account. Not some of it, not most of it, all of it. That's a mandatory Roth contribution, and for millions of Americans, it fundamentally rewrites the retirement playbook. Today, we're covering who this affects, why the IRS made this change, and most importantly, how to build a strategy that works in this new reality. Let's start with some context. The SERC 2.0 Act was signed into law back in December 2022, and it included dozens of provisions designed to reshape American retirement savings. Many of those provisions rolled out gradually. Some started in 2023 and 2024. But the mandatory Roth catch-up rule was deliberately delayed to give employers time to prepare. That delay is now over. The IRS published final regulations in September 2025, and the clock started ticking. January 1st, 2026 is the official compliance date. According to the IRS newsroom, the 401k contribution limit for 2026 has increased to $24,500, up from $23,500 in 2025. For workers age 50 and older, there's an additional catch-up contribution of $8,000. That brings your total potential contribution to $32,500. But here's where it gets interesting. Workers between ages 60 and 63 qualify for what's called the Super Catch-Up provision, allowing $11,250 in catch-up contributions. That means if you're in that 60 to 63 sweet spot, your maximum 401k contribution jumps to $35,750 in a single year. Now here's the critical change. If you're a high earner, defined as someone whose W-2 FICA wages exceeded $150,000 in the prior year, the rules shift dramatically. According to Franklin Templeton's analysis, if your FICA wages exceeded that threshold in 2025, then all of your catch-up contributions in 2026 must be designated as Roth contributions. This isn't optional. It's not a recommendation. The IRS regulations make this mandatory for qualifying high earners, and your employer's payroll system must enforce it. To be clear, only the catch-up portion is affected. Your base contributions, up to $24,500, can still be designated as traditional pre-tax contributions. But that $8,000 catch-up, or $11,250 if you're in the super catch-up window, that money has one destination, a Roth account. Let's talk about what this actually means for your taxes. Traditional 401k contributions reduce your taxable income in the year you make them. You get an immediate tax benefit. Roth contributions work the opposite way. You pay taxes on the money now, but it grows tax-free and you pay nothing when you withdraw it in retirement. As Fidelity's Learning Center explains, high earners can still choose pre-tax or Roth for their base contributions up to the $24,500 limit. Only the catch-up must be Roth. For someone earning $200,000 in a high-tax state like California or New York, losing that pre-tax deduction on catch-up contributions could mean $2,000 to $3,000 in additional taxes this year. That's the short-term hit, but the long-term picture is different. Over 20 or 30 years, tax-free growth on those Roth contributions could potentially outweigh the upfront cost. Here's a critical detail from Fidelity. If your employer's 401k plan doesn't offer a Roth option, you cannot make any catch-up contributions at all as a high earner. According to Fidelity, employers were given until the end of 2026 to add Roth options to their plans. But that deadline creates a gap where some workers may be temporarily locked out. This is your first action item. Check with your HR department now, today, and confirm that your company's 401k plan offers Roth contributions. If it doesn't, ask about their timeline. Charles Schwab's guide notes an important exception. If you have self-employment income but no W-2 wages from your plan sponsor, you may be exempt from the mandatory Roth rule. This matters for partners in law firms, medical practices, or consulting firms who receive K-1 income rather than traditional wages. The rules apply differently to your situation. If you have mixed income sources, both W-2 wages and self-employment income, consult with a qualified tax advisor. The threshold calculation can get complicated quickly. The IRS also raised IRA contribution limits for 2026. The base limit increased to $7,500, and the catch-up for those 50 and older rose to $1,100. For Roth IRA contributions specifically, income phase-outs apply. Singles start losing eligibility at $153,000, with full phase-out at $168,000. For married couples filing jointly, the Roth IRA phase-out begins at $242,000 and ends at $252,000 according to IRS guidelines. Now, you might be thinking, wait, I already exceed those Roth IRA limits. How does this 401k rule affect me? Here's the distinction that matters. The Roth IRA income limits and the 401k Roth catch-up rules are separate systems. There's no income limit on making Roth contributions through your employer's 401k plan. So even if you earn $500,000 a year and can't contribute directly to a Roth IRA, you can, and now must, make Roth catch-up contributions in your 401k. According to IRS regulations cited by Fidelity, employers must make a reasonable good faith effort to comply with these rules as of their effective date, even though formal regulations take effect in 2027. I know this feels complicated. Let me simplify the decision framework. The question isn't whether to comply because that's mandatory. The question is how to optimize around the new rules. Your first move, pull your 2025 W-2 as soon as it's available. Look at Box 3 or Box 5 for your FICA wages. That number determines whether you're above or below the $150,000 threshold. If you're below the threshold, you still have flexibility. You can choose traditional or Roth for all your contributions. Consider your current tax bracket versus your expected retirement bracket. If you're above the threshold, accept that catch-up contributions will be Roth. But remember, you still control the base $24,500. That's where your tax planning flexibility remains. For those in the 60 to 63 super catch-up window, this is potentially your highest contribution years ever. $35,750 in a single 401k is historically unprecedented. Morningstar's analysis confirms these super catch-up amounts represent the highest contribution limits in 401k history. This 4-year window won't come around again for these workers. If you're approaching 60, run the numbers now with a financial advisor. Determine whether your budget can accommodate maximum contributions during those 4 critical years. Let's address the elephant in the room. Some critics argue this rule unfairly targets high earners by eliminating tax planning flexibility, particularly in high-tax states. Supporters counter that Roth contributions provide substantial long-term benefits, tax-free growth, tax-free withdrawals, and no required minimum distributions during the account holder's lifetime. There's also debate about whether $150,000 is the right threshold. In expensive cities like San Francisco, New York, or Boston, that income doesn't feel like wealthy. But the law is the law, and historically, when Congress sets income thresholds, they rarely adjust them quickly. Plan for this $150 threshold to remain static for years. Here's an important mindset shift. Instead of viewing mandatory Roth as a penalty, consider it forced diversification of your retirement tax treatment. Having both pre-tax and Roth balances gives you flexibility in retirement. You can manage your tax bracket year by year, drawing from whichever bucket minimizes your tax burden. AARP's analysis of the 2026 changes confirms that tax diversification has become increasingly valuable as future tax rates remain uncertain. If you found this breakdown helpful, consider subscribing. We cover changes like this every week so you can stay ahead of the rules that affect your money. Let's build your action checklist. Step 1. Confirm your plan offers Roth. Step 2. Check your 2025 W-2 for FICA wages. Step 3. Decide your base contribution split. Step 4. If you're 50 or older, calculate your maximum catch-up amount. Step 5. If you're 60 to 63, model the super catch-up impact on your retirement projections. Step 6. Consult with a qualified financial advisor to stress test your strategy. These rules interact with your complete financial picture in ways that generic advice can't capture. Remember, tax laws are complex and your situation is unique. What works for a software engineer in Texas differs from what works for an attorney in Manhattan. Past performance and historical patterns don't guarantee future results. Tax rates change, life circumstances change, and your optimal strategy today may need adjustment tomorrow. Here's the bottom line. January 2026 brings a mandatory shift for high earners. Your catch-up contributions must be Roth. That's not negotiable. But within that framework, you still have choices. Maximize your base contributions thoughtfully. Take advantage of super catch-up if you qualify, and diversify your tax treatment. This is Money Moves Daily. The signal you needed, mandatory Roth catch-ups for high earners starting 2026. Now you know the rules. Make your move. This content is for educational and informational purposes only and does not constitute financial advice. Always consult with a qualified financial advisor before making investment decisions.